Rates are sitting at their lowest point since October of 24, but the calm that we have experienced in recent weeks could unfortunately be gone this very week. A major inflation report, also known as CPI, is coming, and it could decide whether we drop towards the low 6% range or bounce back up to the 7% range. So now let's talk about the current rate picture. There are three main sources that track rates: Freddie Mac, Mortgage News Daily Average, and Mortgage Bankers Association Weekly. Freddie and MBA are both weekly surveys, while Mortgage News Daily is actual lender data. So to simplify things, Mortgage News Daily reacts faster to market moves. After last Friday's weaker job report, bonds rallied hard, but lenders couldn't fully adjust in one day. But Monday's calm let them bring rates down more. And this is why we saw the lowest levels in nearly a year, holding the mid 6% range from top tier borrowers. So now let's talk about why rates dropped last week. You had weaker job reports, traders expect less Fed tightening, bond yields fall, mortgage rates follow. Job data is a big deal because the Fed needs to see slowing job growth and slowing inflation to consider rate cuts. ISM Services data gave mixed signals. ISM Services index came in at 50.1, barely above the 50 mark. That separates growth from contraction. This is a sign the services sector, which is the largest part of the economy, is slowing down. Slower growth is usually good for rates. But here's the catch. ISM services prices hit 69.9, the highest post-pandemic reading. That's strong inflation pressure. The Fed hates to see high inflation in services because it's often stickier than goods inflation. Traders focus more on slowing growth signal, which helps rates hold steady, but the inflation number is a warning flag for the future. Let's talk about upcoming data that could break the calm. Tuesday, August 12th, core CPI is the big one. Forecast is 0.3% versus the prior 0.2%. Even a 0.1% beat or miss can swing rates noticeably. If CPI is hotter than expected, rates will likely move higher quickly. If CPI is cooler than expected, we could break toward the low 6% range. On Thursday, you have jobless claims and PPI. This can reinforce or counter the CPI narrative. Then you move to Friday's retail sales and consumer sentiment. Secondary impact, but still market moving if big surprises happen. Now let's talk about some historical perspective. September of 2024, we hit low 6% range after several months of lower inflation, plus softer jobs reports. Early 2025, rates peaked just over 7% after hotter inflation data. This shows it takes more than one friendly report to push rates substantially lower. We need a trend. Now, what this means for buyers, refinancers, and agents: if you're a home buyer, you're in escrow now, consider float down option or rate lock. CPI could move things fast. Refinancers, have your application ready so you can lock quickly on any rate dip. The last thing you want to do is be like those back in August and September of 2024 that missed a major opportunity. And if you're a real estate agent, use this info to guide clients. The difference between locking this week versus after CPI could be a few $100s a month in payment. Right now, we're in a holding pattern, but this week's CPI could be the biggest mover we've seen since the jobs report. So that's all I have for you for this week's Monday market update. If you want to stay tuned on what we can expect that came from this week, subscribe because we are going to be keeping these Monday market updates rolling going forward.